Used to be called small bank Capitec, but it isn't so small anymore. It's adding about 1 million clients a year to its growing list. FirstRand is a bit cautious about the future. We're seeing FNB closing branches. Old Mutual separating itself into four and reducing its stake in Nedbank. And while full year profits were up 27%, Standard Bank is, as all banks, worried about South Africa's sovereign credit rating. And recently, Barclays PLC shed new light on how they plan to deal with their 62% stake in Barclays Africa. They announced recently they wanted to reduce that stake. This is the Moneymakers. I'm Bruce Whitfield. Let's talk about one of the sectors worst affected by the sacking of Nhlanhla Nene as finance minister on 9/12. But also, there is a global banking outlook. There's a global regulatory regime that has to be considered as well. In our Cape Town studios, we're joined by Chris Steward. He's the head of financials at Investec Asset Management. Some detail coming through from Barclays PLC, Chris Steward, as to what they plan to do with Barclays Africa. Just give us a summary of the highlights of what was, I think, a 34-page note on the issue.
Barclays have indicated, as they indicated at the time of the results released from Barclays Africa, that they intend to sell down their stake. The core view is that they're going to sell it down to somewhere just below the 20% mark. 18% is the benchmark they've used in some of the documentation that they've set out. They are applying for shareholder approval to do so, basically because shareholder approval is required in order to sell down below the level at which they consolidate for their stake from an accounting point of view, which would be the 50% plus one or controlling shareholding. So they're applying for approval to sell down. That will happen at some stage. There's no real detail as to exactly when they're going to do it. And they are in all likelihood going to sell down to somewhere around an 18% stake.
Now, for many people, they'll go, oh, this is all to do with Nhlanhla Nene. It's all to do with confidence. It's a lack of confidence in South Africa's leadership. It's a lack of confidence on the African continent. In real terms, it's something considerably more boring, and it's something called Basel III and global banking regulations. Is that why this level of 18 to 20% is being mooted? Is it that level that is crucial in terms of global regulatory regimes?
Yeah, the problem is that Barclays is viewed as the controlling shareholder and the supporting shareholder for Barclays Africa, and as a consequence of that, they have to hold a certain amount of capital against their investment. Given that Barclays is what is termed a G-SIFI, or a globally systemically important financial institution, which is quite a mouthful. Yep. They have to hold additional capital overlays against their investment. Essentially, they have to hold capital against 100% of the investment in Barclays Africa, yet by virtue of the fact that they only own 62% of the asset, they only accrue 62% of the profits. So you're holding 100% of the capital and all of the additional capital overlays that the UK regulator and the global regulatory bodies require in order to derive only 62% of the economics. And they put it quite clearly in the document they released, and that is that although Barclays Africa themselves generate a return on the capital that shareholders entrust with them currently of about 17%, once you've added all the additional capital overlays, all the additional bank taxes that Barclays Group or Barclays PLC have to hold, the return they get on the investment for their shareholders reduces down to about 9%. That doesn't meet the threshold for returns that they've promised to their shareholders, which is at least their cost of capital, or approximately 11%. And as a consequence of that, they would like to largely exit that investment, at least down to a stake where they are no longer deemed shareholder of reference. And once they're no longer deemed the shareholder of reference, then they would no longer have to hold all of these additional capital buffers, and the returns start to look a little bit more palatable for their shareholders. And in addition to that, they have less capital deployed against their investment across the African continent.
Now, things have changed dramatically since the days when a man called Errol Kruger was the registrar of banks, the regulator in South Africa, the banking system. He hated minority stakes. He would have pushed back quite strongly, I suspect, against the notion of anybody having a stake of 18 or 20% in a bank. It's significant, but it's not decision-making. What is the current regulator's view on minority stakes in banks and the wisdom of it?
Yeah, I mean, I think another important question aligned to that is what is the current regulator's view with regard to a bank having a shareholder of reference? Clearly, if a bank has a shareholder of reference, let's say 62% that Barclays currently holds makes them that shareholder of reference, then hopefully in the event that there is a capital call from Barclays Africa, Barclays PLC are there and obliged to provide the capital that might be required. So the loss of a shareholder of reference would probably be more of a concern to the regulator than having a residual shareholder who sits with, let's say, an 18 or 20% stake. We have precedents for this.
Yep.
We see that ICBC of China owns a 20% stake in Standard Bank. And in all likelihood, we're going to see Old Mutual ending up with somewhere around a 15 to 20% stake in Nedbank once they've either unbundled that entity or sold it. So it's not without precedent. I don't think that's a big problem. What's going to be quite interesting is what if the UK regulatory authority says to Barclays, even at an 18% stake, you're the largest shareholder, you are potentially continuing to associate your brand with the Barclays African operations across the continent. Therefore, I'm still deeming you as the shareholder of reference, and therefore I'm still going to require you to hold the various capital overlays that I've required previously. And as a consequence of that, I guess Barclays PLC would in all likelihood want to exit 100% of their stake.
Now, there was a time where they would have had potential buyers queuing up to look at the stake, if not buy it. The global banking environment has changed very substantially in the last 11 years since Barclays first came in and bought a controlling stake in Barclays Africa. There was talk of HSBC and looking very closely at Nedbank. There were all kinds of rumours of banks looking at the FirstRand group and looking at opportunities in South Africa as this great launch pad onto the African continent. And then we saw the ICBC deal with Standard Bank where they took just under 20%. Those buyers, my sense is the queue, if there is one, is going to be a whole lot shorter than it might have been 5 or 6 years ago.
Yeah, I think there's a variety of reasons at play here, Bruce. You're quite correct. Most of the obvious historic buyers, the Standard Charters of this world, the HSBCs of this world, first of all, would suffer many of the issues that Barclays PLC themselves suffer in terms of having to hold capital against 100% of risk-weighted assets, but only deriving a portion of the economics. So from that perspective, they wouldn't be that keen. HSBC and Standard Chartered in particular have some problems of their own. Standard Chartered is short capital, and as a consequence, they're not going to go out and buy into emerging markets businesses. And in fact, both of those entities are actively exiting their emerging market investments at the moment. So the regulatory environment has played against it, and there are some idiosyncratic issues impacting on the obvious acquirers. That's before we look at the potential for a multi-billion dollar deployment of capital into South Africa, where there must be some concerns as to what if the sovereign rating of South Africa is downgraded, what impact does that have on the currency further? There's some of the political issues that are currently playing out within the country, which would make foreign investors particularly cautious. And there is, in all likelihood, a fairly difficult operating environment that one can expect for South African banks for the foreseeable future. We've got fairly indebted consumers, we've got rising interest rates, and we've got very moderate domestic growth. As a consequence of that, there's no guarantee that South African banks are going to be able to grow their profitability, even in rands, over the next 18 months. So I think buyers will be very, very cautious at this stage. And the biggest question out there is not why does Barclays want to sell, but who in fact is going to step up to the plate and buy those shares, and what discount are they going to require in order to do so.
And we're stuck in an unprecedented situation where two South African banks' shares and controlling stakes are potentially up for grabs. Old Mutual looking to relinquish control of Nedbank and has stepped up to the plate several times in the last 20 years for Nedbank. And then you've got the decision by Barclays to walk away from a big controlling stake in Barclays Africa as well. Nedbank and Old Mutual seem to have a different approach. They're prepared to unbundle their shares. Old Mutual is in Nedbank. That looks like a likely solution for them.
Yeah, not without its complexities, Bruce. They would need to do a number of restructurings before they're in a position to unbundle those shares, simply because approximately half of Old Mutual's register sits offshore. and you can't simply unbundle a South African listed bank to offshore shareholders and say, good luck guys, there you go, have some Nedbank shares. They're not listed on your local exchange, but sorry about that. That's not feasible. So what Old Mutual would need to do is they would need to restructure their business in such a way that once they unbundle those Nedbank shares, if that's the route they ultimately elect to go, those Nedbank shares find their way into the hands of investors who are able to own those shares according to the mandates under which they manage money. That will probably involve Old Mutual selling a number of its international businesses, particularly the US asset management business first, and then orchestrating some sort of split of their developed market and emerging markets businesses, such that they only have emerging market shareholders of the emerging markets business where the Nedbank shares lie, and then those Nedbank shares can be unbundled to shareholders who, whilst they might not necessarily want to hold those shares, have the ability to hold them and the ability to sell them on the domestic exchange.
None of this is going to happen overnight. So what does it then mean for the price people will be prepared to pay over the next 2, 3, 5 years for South African bank shares? It almost puts an artificial cap, doesn't it, on share prices of banks?
Yeah, I mean, this process of putting big stakes of assets up for sale before you've got a plan as to how you're going to execute on that sale is curious and something very new to me. We've seen Anglo American do it with Kumba a little bit earlier this year. We've now seen both Old Mutual and Barclays PLC do it with regard to their stakes in Nedbank and Barclays Africa Group respectively. It's curious, it's unusual. I think it smacks of an environment where maybe you're desperate to restructure, but you don't necessarily have all the answers. And as you point out, it does lead to fears of a potentially quite material overhang for those two counters in particular. But if you're a shareholder sitting with certain of the other South African banks, there's a natural weighting of South African banks that you would like to hold in your portfolio. And if you expect that you're going to get some ABSA shares or some Barclays Africa Group shares, I beg your pardon, and some Nedbank shares at bargain basement prices, the likelihood is that you're going to make some space in your portfolio by selling some of your other South African bank holdings. So the overhang, in fact, has the potential to put a depressing or to have a depressing impact on the valuation of all of the big four South African banks for the foreseeable future. I would be disappointed if it took the 2 to 3 years that's been alluded to for these restructurings to play out. I think once you've made the announcement, time is of the essence. I think the South African regulatory authorities would be very concerned if they thought that this was an overhang that was going to persist for that sort of amount of time. So I'd hope there's a whole lot of corporate financiers out there working 24/7 around the clock to try to resolve these issues within an acceptable time frame of, let's say, by the end of this year.
Chris Steward in our Cape Town studios. Chris Steward is head of financials at Investec Asset Management. Got great insights into the big impact that the sale of two big stakes in South African banks, Nedbank and Barclays Africa, is going to have on the entire sector, of course, on the overall market as well. More issues to discuss, more money to discuss on the Moneymakers. That's next time. Thank you very much for watching this evening. Bye-bye.